here. Awesome. Let's look at some numbers.
Sure. So here we're going to take a look at the last 3 years. And I think this is a good look because, as Brian mentioned, companies had some stumbles. It's sort of floundered in a few important markets, the college athletics market. It sort of missed the athleisure trend, although it's coming back now. Brian talked about the wearables business not being a great decision. So these stumbles are reflected in the last few years of results. Revenue hasn't been that bad. So, and I apologize for this. We did one of these a couple of weeks ago, Brian, where we had a company that breaks out all these quarterly columns in their annual report. So I will make up for that by telling you what we're looking at. What we're trying to focus on is this part of the screen right here. So the 3 years ended December 31st for 2019, 18, and 17. Not bad revenue growth, really, in the consumer goods business. Not quite like Nike's, but this is a company that grew at a much faster rate until it hit some brand problems. And pretty stable margins. As you can see, that's over here, that's the cost of goods sold on this line. This is the gross profit. A little bit of step up in general and administrative expense. This is basically overhead. And what we see here is the effect of restructuring and brand impairments on the bottom line, at least on a net income basis. So you see the company had actually an operating loss in 2017. The same thing in 2018, a slight loss here, but no impairments. So these lines are restructuring, impairments, et cetera. So when you look at net income, it's not been that rosy for the last couple of years. How does this translate into cash flow there? By comparison? Well, as Brian mentioned, there is a business here. So if we're focusing on cash flows, they've been pretty solid. This is the last 2 years. So, sorry, it's the balance sheet. Let me make sure I get that. There we go. So you can see those. Why is this doing this to me? Hang on 2 seconds. Let's try that again. All right, I have an over-eager mouse here. So here we are looking at those last couple of years of losses. Those operating losses translated into net income losses. And still through that, you see that operating cash flow is growing, and it's pretty stable. So $500 million last year on $92 million of net income. The outlay for property and equipment has sort of flopped around, but not overly big for a company that has a pretty decent store presence still, although it's trying to increase those direct channels. So the company is generating some free cash flow, and cash balances have been growing. They've really come along, and that's reflected in the balance sheet. Now I want to quickly look, and I know we're doing a half-hour session, so I have to be quick. I wanted to take a look at the most recent quarterly report. And here you see something that doesn't look all that different from Nike's consolidated statement of operations. So this is a pandemic report where sales are markedly down year over year. So this was the prior quarter, about 1.2 billion sales versus just 700 million sales, 708 million in sales this quarter. So the company's got a pretty big loss in its most recent quarter, but that's not very different than Nike, which I've also pulled up here. So Nike also had a 38% drop in its revenue. Of course, it's a much bigger company, so $10.2 billion of revenue in one quarter versus $6.3 billion. The difference in these two companies is the prior year period for Nike was extremely profitable. So if you look at the year ago period, it had almost $1 billion in profit. Just going back here to this screen, taking a look at what happened with Under Armour, if you compare it to the same quarter last year, they again were losing money. So what we're seeing on the books is a company that is trying to reformulate its brands. It's trying to optimize its revenue, trying to increase direct sales, which are much more profitable when it can do it through the e-commerce channel, trying to diversify into an international business, as Brian mentioned. And it's taking some time. And the stock price, I think, has suffered. Maybe Brian can show us that in a minute here. But we're looking at a company that has had some missteps. Finally, let's just take a quick look at the balance sheet, which is on the same statement in the most recent quarter. And you'll see it's pretty solid. To go back to your theme, Brian, there's a business here. We've got about $3.1 billion in working capital as of June 30th, 2020. I will point out that inventory is bumping up because sales are slowing. So that's something to watch if you're a shareholder in the coming quarters? Is that inventory going to normalize, or is it going to keep bumping up? They were trying to fix their inventory problems before this, and COVID has not helped. But against those current assets, only about $1.6 billion in current liabilities. Not a lot of long-term debt on the books in comparison. If you're the type of person who likes to look at, a net debt type of look, not too bad. They're positive on that. In other words, they've got $1.1 billion in cash versus about a little bit less than $1 billion in long-term debt. So a solid picture on the balance sheet, not a super one, but certainly not a company that you would say, oh, they're not going to be able to make a comeback. These problems are more about marketing, brand, the investments that the company is making in operations versus a turnaround situation where you could see, oh, that writing's on the wall and they're not coming back. They could make a comeback. I just don't know if it's going to be an overnight comeback, Brian, from the financials.